The rising dollar. Who wins, who loses in the global currency war? Introduction. The rising dollar. Who wins and who loses in the global currency game? Every time the US dollar strengthens, something shifts beneath the surface of the global economy. It's not just a currency getting more expensive, it's a realignment of financial power that ripples across every continent. From Wall Street boardrooms to remote factories in Southeast Asia, the consequences are felt in subtle but profound ways. Right now, the dollar is rising again, reaching levels not seen in years against major currencies like the euro, the yen, and the Chinese yuan. To some, it signals economic strength and global trust in America's stability. But for others, it spells debt crises, inflation, and trade imbalances. Why does the US dollar have this kind of power? Why can one nation's currency dictate the fate of so many others? And most importantly, who actually benefits when the dollar gets stronger, and who quietly suffers? In today's episode of Bold Steps Forward, we break down what a strong dollar really means, far beyond the headlines. We'll explore who the unexpected winners are, those who quietly profit in times like this, and reveal who bears the hidden cost. You might be surprised to find that not all the losers are small nations, and not all the winners are who you'd expect. We'll also unpack the hidden mechanics behind this phenomenon, how Federal Reserve interest rate hikes, capital flows, and geopolitical trust all converge to make the dollar the most dominant force in global finance. You'll hear real stories of governments under pressure, companies watching their margins collapse, and households struggling as imported goods skyrocket in price. But here's the twist. While the dollar's strength might seem like a US advantage, the bigger question is, can the world continue to rely on it? Or are we watching the start of a slow but certain shift in the balance of financial power? Whether you're an investor, a business owner, or just someone curious about how global money really works, this story affects you. Because when the dollar moves, the whole world reacts. And in today's connected economy, that reaction could impact your job, your savings, even the price of your groceries. So stay with us. Like, subscribe, and turn on notifications, because what we uncover next will reshape how you see money, markets, and America's real power in the world. Chapter 1. The mechanics behind a strong dollar. At first glance, a rising US dollar might seem like a sign of prosperity, proof that the American economy is strong and that the world continues to trust in the stability of the United States. But the story goes deeper than headlines or exchange rate charts. So, what causes the dollar to rise? The answer lies at the intersection of monetary policy, global capital flows, and international confidence in the U.S. financial system. Let's start with the most immediate trigger: interest rates. When the Federal Reserve raises interest rates to fight inflation or cool down an overheating economy, it makes U.S. assets, bonds, stocks, and even bank deposits more attractive to foreign investors. Higher returns attract capital from around the globe, and those investors must convert their local currencies into dollars to participate. The result? More demand for dollars, pushing the price up. In short, higher rates mean stronger dollar. That's exactly what we've seen in recent years. In response to post-pandemic inflation, the Fed aggressively raised interest rates throughout 2022 and 2023. As a result, the dollar surged, reaching 20-year highs against some currencies. But interest rates are only part of the equation. Another key factor is the dollar's role as a safe haven currency. In times of uncertainty, whether caused by war, a global pandemic, or financial market turbulence, investors around the world flee to what they perceive as the safest and most liquid asset, the US dollar. It doesn't matter if you're a bank in Germany or a pension fund in Singapore. When markets panic, the dollar is where you go. This status is unique. The dollar isn't just a national currency, it's the backbone of global finance. Nearly 60% of global foreign exchange reserves are held in dollars. Over 80% of global trade is invoiced in dollars, even when the US isn't directly involved. That gives the greenback an immense amount of influence, and when confidence in other parts of the world falters, that influence grows stronger. But there's more. The petrodollar system, established in the 1970s, also reinforces the dollar's dominance. Oil-exporting nations price and trade oil in dollars, creating constant global demand for the currency. That demand doesn't disappear when oil prices fall. If anything, it rises as countries need more dollars to purchase the same volume. So, when all these forces align, tight monetary policy, economic uncertainty abroad, and rising energy costs, the dollar strengthens, sometimes rapidly. Now, here's where it gets personal. Imagine you're a small manufacturing business owner in Vietnam. You import raw materials from Europe and sell your products in the US market. A stronger dollar means you earn more in local currency when converting your US sales, but it also means your imported components, priced in euros, become more expensive in USD terms. If you've signed long-term contracts in USD but your costs rise unexpectedly, your profit margins get squeezed. You're stuck. Or picture a government in sub-Saharan Africa with outstanding loans from US banks. Every time the dollar rises, the local currency value of that debt rises too, without any change in the actual loan. Servicing that debt becomes harder, leading to budget cuts, inflation, and social unrest. This scenario played out in countries like Ghana and Zambia during recent debt crises, triggered largely by the dollar's ascent. This brings us to a core truth. The dollar is not just America's currency, it's a global force. And when it rises, it sends shockwaves that impact businesses, consumers, and entire governments in ways that aren't always visible on the surface. And here's the paradox. For many countries, their central banks have to defend their own currencies when the dollar strengthens, often by raising interest rates themselves. But doing so slows their domestic economies, increases borrowing costs, and stifles growth. In essence, they're forced to make sacrifices to protect their currencies against the gravitational pull of the dollar. Meanwhile, for the US, a strong dollar is a double-edged sword. While it helps keep imported inflation in check, making foreign goods cheaper for American consumers, it also hurts US exporters. When American-made products become more expensive abroad, it cuts into competitiveness and global market share. Multinational companies like Apple, Boeing, and Caterpillar have all reported weaker overseas earnings during periods of dollar strength. So, while the rising dollar may appear to be a sign of dominance, the underlying reality is much more complex. The dollar's strength reflects global imbalances, capital movements, and shifting power dynamics. And the consequences, both good and bad, are deeply uneven. The key question is, who is benefiting from this new surge in dollar value? Who's quietly celebrating while others are struggling to survive? In the next chapter, we'll uncover the unexpected winners in this global currency game. From American investors to foreign governments playing a clever game of timing, the answers may surprise you. Chapter 2. Who wins when the dollar gets stronger? When the US dollar strengthens, it doesn't just destabilize emerging markets or challenge exporters. It also creates clear winners. Some sectors thrive, investors profit, and entire economies take advantage of this shift. So, who actually benefits when the dollar surges? Let's take a closer look. 1. American investors and global capital flows. Perhaps the most obvious winners are U.S.-based investors. When the Federal Reserve raises interest rates and the dollar strengthens, U.S. financial assets, stocks, government bonds, real estate, become more attractive to foreign investors seeking stability and returns. The math is simple. Higher yields on U.S. Treasuries and a stronger dollar mean not only higher returns, but also reduced currency risk. For a German or Japanese investor, parking capital in U.S. bonds offers safety and the potential for currency appreciation. As capital flows into the United States, markets often rally, especially in sectors like finance, energy, and tech. This capital inflow also supports the dollar itself, creating a feedback loop where strength feeds further strength. In short, a rising dollar often signals a bullish environment for U.S. financial markets, especially when global uncertainty pushes even more investors toward American assets. 2. American consumers, the buying power advantage. Another clear winner? U.S. consumers. A stronger dollar means cheaper imports. From electronics to automobiles, when the dollar rises, American buyers get more for their money. A television made in South Korea or a bottle of French wine becomes more affordable in dollar terms. Even essential goods like pharmaceuticals, raw materials, and industrial components become less expensive when sourced from overseas. That can help businesses keep prices down, especially in an inflationary environment, and give consumers more spending power. For an economy like the U.S., which imports over $3 trillion in goods and services annually, the impact is significant. A stronger dollar acts as a natural brake on inflation, especially for imported products. 3. U.S. government. Taming inflation without fiscal pain. While high inflation has been a major concern in recent years, a strong dollar acts as an indirect inflation-fighting tool for the U.S. government. Here's how. Imported goods become cheaper, reducing the cost of living. Oil and commodities, typically priced in dollars, become more affordable in dollar terms, lessening fuel and food inflation. This allows the Federal Reserve to ease the pressure on interest rate hikes over time, offering more flexibility in economic policy. And while inflation remains a global issue, the U.S. benefits from its dollar dominance by exporting inflation to weaker currency economies. It's a quiet but powerful edge that few countries enjoy. 4. Energy and commodity importers outside the U.S. It may sound counterintuitive, but some foreign countries also benefit from a strong dollar if they import commodities and manage their economies effectively. Take Japan, for example. While the yen weakens against the dollar, Japanese companies that import raw materials or oil may actually pay less in dollar terms, depending on contract structures. In some cases, they hedge currency risks in advance and benefit when the dollar strengthens more than expected. Additionally, countries like India and South Korea, with large tech and pharmaceutical sectors heavily tied to the U.S. supply chain, sometimes see investment inflows even during dollar surges, especially when they manage interest rates to stay attractive to investors. So while emerging markets as a group often struggle, some well-positioned economies quietly benefit, especially those with strong dollar reserves, export exposure to the U.S., and sound fiscal management. 5. Multinationals with dollar-based revenues. Let's not forget multinational corporations that earn a large portion of their income in dollars. Think of companies like McDonald's, Coca-Cola, Microsoft, and Visa. These firms may manufacture or operate globally, but their revenues are often pegged to or collected in dollars. When the dollar strengthens, their foreign operating costs shrink in relative terms, boosting margins, especially in low-cost labor markets. For example, a company that operates a call center in the Philippines or a factory in Mexico sees its local expenses fall when converted to dollars, while still charging customers in U.S. currency. That's a direct profit boost. Many of these companies also carry debt in other currencies. As the dollar strengthens, they can use their rising U.S. cash flow to pay off foreign-denominated liabilities more easily. 6. Countries holding large dollar reserves. Countries like China, Saudi Arabia, Japan, and Switzerland hold hundreds of billions, sometimes trillions, of dollars in foreign exchange reserves. When the dollar strengthens, the value of these reserves appreciates, giving their central banks more power and flexibility. This also allows these governments to defend their currencies, fund development projects, or support domestic financial systems during times of crisis. In fact, many countries intentionally accumulate dollars as a strategic buffer against global shocks. When the dollar rises, their reserve position improves. Final thought: strength in silence. While many headlines focus on who suffers when the dollar strengthens, the winners are often quieter: strategic investors, multinational corporations, and governments that prepared in advance. A strong dollar reshapes the global financial system in subtle but decisive ways. Those who understand the mechanics, hedge their risks, and position themselves wisely don't just survive, they thrive. But if there are clear winners in this game, the natural question is, who's paying the price? Because every financial shift, especially one as powerful as the rise of the dollar, leaves someone else exposed. In the next chapter, we'll explore who's getting hurt, how a rising dollar triggers crises, crushes economies, and fuels inequality across the world. Chapter 3. Who loses when the dollar gets stronger? While some quietly profit from a surging U.S. dollar, many others suffer, often severely and silently. The dollar's global dominance doesn't just create winners, it creates pressure points. And when that pressure builds, it breaks economies, strains households, and deepens global inequality. So, who bears the cost when the dollar climbs? 1. Emerging markets drowning in dollar-denominated debt. One of the most immediate and painful effects of a rising dollar is felt by emerging market economies with dollar-denominated debt. These are countries that borrow in dollars because investors view their local currencies as too risky or unstable. But here's the problem: when the dollar rises, the value of their debt skyrockets in local currency terms, even though the actual loan amount stays the same. Servicing that debt becomes harder, requiring more domestic revenue to pay off the same dollar-denominated loan. Countries like Argentina, Turkey, Sri Lanka, Egypt, and Pakistan have faced near collapse because of this dynamic. In some cases, governments are forced to cut essential services, raise taxes, or seek bailouts from institutions like the International Monetary Fund, IMF. A rising dollar can tip already fragile economies into crisis. 2. Local businesses and importers in weak currency nations. Picture this: a small business in Nigeria imports machinery parts from Europe, paying in euros. The local currency, the naira, is weakening. But when the dollar rises, the naira drops even faster, and the cost of those parts, converted through the rising dollar, explodes. This is a common scenario across Africa, Southeast Asia, and Latin America. Importers get squeezed, struggling to maintain operations as the cost of goods soars. Many of these businesses operate on razor-thin margins. They can't easily raise prices to match rising costs, especially in low-income consumer markets. So they cut staff, reduce production, or shut down entirely. The ripple effect? Job losses, reduced tax revenue, and rising poverty, all because the dollar strengthened. 3. Consumers facing imported inflation. A stronger dollar might help U.S. consumers, but it has the opposite effect elsewhere. In countries whose currencies fall against the dollar, everything priced in dollars gets more expensive: fuel, food, medicine, electronics. This leads to what economists call imported inflation. And unlike local inflation, which governments can try to control with interest rates or subsidies, imported inflation is far harder to tame. In Ghana, food prices jumped over 30% in just a few months during a recent dollar surge. In Pakistan, fuel costs nearly doubled. These are countries where millions already live near or below the poverty line. For families living paycheck to paycheck, the impact is devastating. It's not just economics, it's survival. For central banks caught in the crossfire. To defend their weakening currencies, many central banks in developing countries raise interest rates. But this isn't always voluntary. It's often a last-ditch effort to slow capital flight and avoid a currency collapse. But high interest rates have a price. Business loans become more expensive, slowing investment. Consumers stop spending, weakening domestic demand. Recession risks rise as economies cool down too quickly. This is the trap. Countries are forced to tighten their economies just to prevent further damage from the dollar's rise. They're not making growth-oriented decisions. They're defending their survival. This policy paradox has played out across Indonesia, South Africa, Brazil, and Egypt, where central banks have little choice but to match or follow the Federal Reserve's lead, often at the expense of their own economies. 5. Exporters in the U.S. and multinational struggles. Not all the pain is offshore. A strong dollar hurts American exporters, too. When the dollar rises, U.S. goods become more expensive for foreign buyers. This reduces competitiveness, cuts into global sales, and affects revenue. Take Boeing or Caterpillar, two U.S. giants with significant international exposure. When the dollar is strong, foreign airlines and construction firms often delay purchases or turn to cheaper non-U.S. alternatives. The result? Lower profits, reduced hiring, and sometimes layoffs. Even U.S. tech giants like Apple and Microsoft take a hit. In earnings calls, executives often cite foreign exchange headwinds as a major reason for missing targets. The irony is clear. While the dollar's rise reflects economic strength, it can undermine American business performance abroad. 6. Tourism and hospitality, dollar too strong to attract visitors. When the dollar strengthens, it becomes more expensive for foreign tourists to visit the U.S. A vacation to New York or Los Angeles suddenly costs 10 to 20% more for a traveler from Europe or Asia just because of currency movements. As a result, international tourism to the U.S. often declines during dollar surges, hurting hotels, airlines, restaurants, and attractions that depend on foreign spending. At the same time, Americans find it cheaper to travel abroad. That might sound good, but it means more tourism dollars leaving the U.S., adding pressure to an already strained domestic hospitality sector. The hidden cost of dollar dominance. So while a strong dollar brings power and prestige, the human and economic cost is real and rising. In a globalized economy where the dollar acts as the anchor, its every move sends aftershocks. And for millions of people, those aftershocks come in the form of empty shelves due to unaffordable imports, layoffs in export-driven industries, debt defaults in countries with no fiscal wiggle room, price hikes that put medicine, fuel, and food out of reach. These aren't just statistics. They're stories of families skipping meals, businesses closing doors, and governments teetering on the edge of collapse. And all of it ties back to a currency many of them do not control, but are forced to live with. The dollar may rise silently, but for many, it roars through their lives like a financial hurricane. In our next chapter, we'll ask the big question: how long can this imbalance last? Is the world still willing to live under the shadow of a single dominant currency, or is a shift already underway? Stay with us, because the answers might signal the next great transformation in global finance. Chapter 4: What's next for the US dollar and the global financial system? The US dollar has ruled the global economy for nearly a century as the world's reserve currency, the ultimate safe haven, and the beating heart of international trade. But as the dollar grows stronger and the imbalance deepens, a question is rising in financial capitals from Shanghai to Sao Paulo. How long can this last? The future of the dollar is no longer just a financial debate. It's a geopolitical battleground, a technological race, and a question of who truly holds power in the 21st century economy. Let's explore where things are headed and what could reshape the global financial system as we know it. 1. Dollar dominance. Still strong, but under scrutiny. The US dollar accounts for nearly 60% of global foreign exchange reserves, over 80% of global trade invoicing, and dominates 90% of all forex transactions. This dominance gives the United States extraordinary privileges. It can borrow cheaply. It can sanction nations and freeze reserves. It can export inflation and import deflation. But this power comes with responsibility, and now with resistance. Emerging economies are increasingly uncomfortable relying on a currency they do not control, especially after seeing how the US can weaponize the dollar through sanctions, as it did against Russia, Iran, and Venezuela. Central banks are diversifying reserves, holding more gold, yuan, and euros. Some nations are settling trade in local currencies or through currency swap agreements. The dollar remains strong, for now, but its supremacy is no longer unquestioned. 2. China's challenge. Can the yuan replace the dollar? China, the world's second-largest economy, has made clear its ambition: internationalize the yuan, renminbi. Over the past decade, Beijing has launched the Cross-Border Interbank Payment System, CIPS, as an alternative to SWIFT, increased bilateral trade in yuan, and struck currency swap deals with over 30 countries. Its digital yuan, eCNY, already in public trials, could make cross-border payments faster and more efficient. But there are serious obstacles. The yuan isn't fully convertible. China's capital controls limit outflows. Foreign investors still lack confidence in Chinese legal and financial transparency. Despite its economic might, trust remains a key factor, and the yuan has yet to earn it at a global scale. Still, the trend is clear. China is playing the long game, and its influence is growing, especially in Asia, Africa, and parts of Latin America. 3. The rise of BRICS and alternative systems. In recent years, the BRICS bloc, Brazil, Russia, India, China, and South Africa, has moved toward creating alternative financial structures that reduce reliance on the dollar. At their summits, they've discussed a BRICS reserve currency backed by gold and commodities, regional payment systems outside of SWIFT, expanded trade settlement in local currencies. Russia and China are already conducting energy trade in rubles and yuan. India has paid for Iranian and Russian oil in rupees. Brazil and Argentina have proposed a shared South American currency. The world isn't ready to ditch the dollar yet, but these parallel systems could weaken its grip over time. If more countries start choosing alternatives, network effects could accelerate the shift, especially if triggered by another financial crisis or geopolitical shock. 4. Digital disruption. Will tech redefine currency? Beyond geopolitics, technology is rewriting the rules of money. Central bank digital currencies, CBDCs, are now a major trend. Over 130 countries are exploring or piloting their own digital currencies, including the US, Europe, China, and India. These digital currencies promise faster payments, greater transparency, and reduced reliance on intermediaries like SWIFT or correspondent banks. They also represent a new kind of financial control, where governments can program money, track transactions in real time, and even restrict usage. If CBDCs become interoperable across borders, the role of the dollar as a clearing and settlement layer could fade. Meanwhile, stablecoins and blockchain-based payment networks, like Ripple or Stellar, are creating private alternatives to traditional systems. In this new era, the most important currency might not be the strongest, but the most convenient, trusted, and programmable. 5. The U.S. response: adapt or risk losing influence. The U.S. still holds major advantages. The deepest and most liquid capital markets, a strong rule of law foundation, a massive economy with global reach. But to maintain the dollar's role, Washington must act strategically. That means modernizing payment infrastructure, embracing innovation like FedNow and a digital dollar, avoiding overuse of sanctions, which push countries toward alternatives, strengthening fiscal discipline to preserve global confidence. If the U.S. takes its monetary dominance for granted, others will step in to fill the void. But if it leads the next wave of innovation, the dollar could evolve and stay dominant in a digital world. 6. A fragmented future? The most likely outcome isn't a sudden collapse of the dollar, but a fragmented system. Imagine a world where the dollar, euro, and yuan coexist as trade and reserve currencies. CBDCs handle retail transactions and cross-border settlements. Gold, crypto, and commodities regain monetary relevance. Regional blocs settle within their own payment ecosystems. This future would be more complex, but possibly more balanced. No single country would dominate. No one currency would dictate terms. It's the end of unipolar finance and the beginning of multi-currency competition. Final thought: power, trust, and the next chapter. The dollar's future isn't just about economics, it's about trust. Trust in U.S. institutions. Trust in the rule of law. Trust in innovation. If the U.S. can preserve that trust while adapting to change, the dollar will remain a cornerstone of the global financial system, even as others rise. But if trust erodes through political instability, overreach, or economic mismanagement, then the world will look elsewhere. The next chapter of money is being written right now, through technology, diplomacy, and hard choices. Whether the dollar continues to lead depends not just on strength, but on credibility, resilience, and the ability to evolve. Chapter 5: Hidden Lessons and Untold Truths Behind the Rise of the U.S. Dollar. The U.S. dollar didn't just become dominant by accident, nor has it stayed on top by inertia. Its rise and resilience is the result of war, innovation, strategy, and sometimes sheer audacity. But behind the headlines and economic charts lies a deeper truth. The dollar's story is not just about finance. It's about power, control, and the way the modern world is wired. Let's peel back the curtain and examine what most never see: the hidden lessons and untold truths behind the dollar's global grip. 1. The dollar is a silent enforcer of U.S. power. One of the most overlooked facts about the dollar is this: it gives America the ability to project influence without firing a single shot. When countries fall out of favor, they're cut off from the dollar-based financial system. Their banks are blacklisted, their reserves frozen, and their citizens locked out of global trade. This isn't theory. It has happened to Iran, Venezuela, North Korea, and Russia. The dollar acts as a geopolitical weapon, quiet, powerful, and often untraceable to the public eye. Behind closed doors, world leaders know this. They may criticize the U.S. in speeches, but they hoard dollars in silence, knowing it can buy them access, protection, and legitimacy. 2. The dollar thrives on global instability. Here's a paradox. Every global crisis strengthens the dollar. When war erupts, when markets panic, when pandemics strike, the world runs to the dollar. Because it's not just a currency. It's a symbol of security. That means the U.S. has a unique edge. While other economies collapse under pressure, the U.S. often grows stronger because the dollar's demand surges, allowing the government to borrow more cheaply and spend more freely. In other words, global chaos is good for the dollar. This raises tough questions. Can a system built on crisis truly serve the world's long-term stability? Or is it time to imagine something more balanced? 3. America's biggest export isn't tech or oil, it's the dollar. While headlines talk about Silicon Valley or shale oil, the real export is the dollar itself. Foreign governments buy U.S. treasuries. Corporations borrow in dollars. Banks clear payments through New York. The demand for dollars generates seigniorage, essentially free profit, for the U.S. And it's enormous. Trillions flow into U.S. capital markets, fueling Wall Street, boosting the stock market, and financing America's fiscal deficits. This creates a dynamic few Americans realize. The rest of the world funds U.S. prosperity, not the other way around. It's not just an economic advantage, it's a financial empire built on trust and necessity. 4. The dollar is strong because the world is weak. The dollar's dominance often reflects not just American strength, but global weakness. Europe can't unify its fiscal policy. China struggles with transparency and capital control. Japan is aging and over-indebted. Emerging markets remain vulnerable to capital flight. So the world defaults to the dollar, not because there's no alternative in theory, but because there's no trusted alternative in practice. This is the uncomfortable truth. The dollar wins by default. As long as global rivals falter, the dollar stays king. But that also means its reign is more fragile than it looks. If just one credible challenger rises, digitally efficient, politically stable, economically deep, the balance could shift quickly. 5. The world is building workarounds, quietly. While the dollar still rules, resistance is growing beneath the surface. China and Russia are trading oil and gas in local currencies. BRICS nations are building a joint payment infrastructure. Gold purchases by central banks are at multi-decade highs. Digital currencies are being designed to bypass the dollar. None of these efforts can dethrone the dollar overnight. But they are strategic bricks in a new foundation, laid quietly, persistently, and deliberately. It's not a revolution. It's an evolution, one trade deal, one payment channel, one bilateral swap at a time. 6. Every empire believed it was forever, until it wasn't. History is full of currencies that once ruled the world. The British pound in the 19th century. The Dutch guilder in the 17th century. The Spanish silver real before that. Each believed its system was unshakable, until wars, debt, and changing trade flows eroded their dominance. The dollar is no exception. Its era may be long, but it won't be eternal. And the question is not if change will come, but how and when. Will it be peaceful or disruptive? Gradual or sudden? Cooperative or confrontational? The answer depends on choices made today, in Washington, Beijing, Brussels, and beyond. Final reflection. The real currency is trust. In the end, money is not just paper or code, it's belief. People accept the dollar because they believe in it. They believe in the institutions behind it. They believe in its consistency, its safety, its network. But belief is fragile. And once it breaks, it's hard to restore. The biggest lesson behind the rise of the dollar is this. Trust is the real reserve currency of the world. If the U.S. wants to keep leading, it must earn that trust through transparency, innovation, restraint, and stability. And if the world wants a fairer system, it must build credible alternatives, not just in policy, but in performance. Because in the new era of global finance, power will belong not just to the strongest, but to the most trusted. And that's the truth no one talks about. If you found this story powerful, hit that like button, subscribe to Bold Steps Forward, and share this video with someone who needs a dose of bold thinking today. Stay tuned for more legendary stories of business icons, strategic minds, and the timeless principles that built empires. Until next time, keep thinking different. Keep moving forward.